If your pension payment landed in your account this month and it was smaller than you expected, you are not losing your mind, and you are not alone. Right now, hundreds of thousands of pensioners across the UK are opening their bank apps, staring at the number, and wondering where their money went. The answer, in almost every case, comes down to three letters and a few numbers that most people never think about until it's too late: your tax code. Today, we're breaking down exactly why HMRC has been quietly changing tax codes for pensioners, what it means for your monthly income, how to check if you're affected, and what you can actually do about it. Stick with me to the end, because there's a very real chance you're either dealing with this right now or you will be within the next year. Let's start with the basics, because understanding your tax code is the only way you're going to catch a mistake before it costs you hundreds of pounds. Every year, millions of pensioners in this country receive income from more than one source. There's the state pension, which comes from the Department for Work and Pensions. Then there might be a workplace pension from your old employer, a private pension you built up over the years, or even part-time work you're still doing to top up your income. Here's the part that catches people out. The state pension is technically taxable income, but the DWP does not take any tax off it before it lands in your account. It arrives completely gross, untouched, full amount. So how does HMRC collect the tax that's owed on it? They do it by adjusting the tax code on your other income. Essentially, HMRC reduces your tax-free personal allowance on your workplace or private pension to account for the fact that you've already used up part of that allowance through your state pension. It sounds complicated because it is complicated, and this is exactly where things have been going wrong for so many people lately. For years, the standard personal allowance in this country has been frozen at £12,570. That freeze has been extended multiple times, and it's currently locked in place until April 2031. Meanwhile, thanks to the triple lock, the state pension keeps rising every single year, sometimes by 4, 5, even 6%. Do you see the problem here? Your tax-free allowance is standing still, while your state pension keeps climbing toward it. Every April, when the new tax year begins and the state pension goes up again, that gap between your allowance and your pension income gets smaller and smaller. For the current tax year, the full new state pension sits just a few pounds short of using up the entire personal allowance on its own. That means almost your entire tax-free allowance is now being swallowed up by the state pension alone, leaving barely anything left over to shield your workplace or private pension from tax. This is precisely why so many pensioners have opened their coding notice this year and seen a completely different set of numbers and letters than they're used to. So what does a tax code actually look like, and how do you read it? A typical tax code for someone with a private pension might look something like 205L. The number represents your remaining tax-free allowance multiplied by 10. So 205 means you have £2,050 of tax-free allowance left to apply against that specific pension. The letter L simply indicates you're entitled to the standard personal allowance, with no special circumstances. Compare that to the more familiar code many people grew up seeing, 1257L, which represented the full personal allowance before any of it had been used up elsewhere. When your code drops from something like 1257L down to something much lower, like 205L, that's HMRC telling your pension provider, this person has already used most of their allowance through their state pension, so tax the rest of their income much sooner. And that's exactly why your monthly pension payment has shrunk. More of it is now being taxed at source because there's less tax-free headroom left to protect it. Now, here's where it gets even messier, and where a lot of the recent confusion has genuinely come from. In the last budget, the Chancellor announced that pensioners whose only income is the state pension, with absolutely nothing else coming in, will be given a special exemption, so they never actually have to pay tax on it, even once the state pension itself grows larger than the personal allowance. That change is expected to take effect from around 2027, when the triple lock is projected to push the full state pension above the £12,570 threshold for the very first time. The government has been clear that they want to avoid the political embarrassment of raising pensions with one hand while quietly clawing some of it back in tax with the other. But, and this is the crucial bit almost nobody is talking about, that exemption only applies to pensioners whose sole income is the state pension. If you have so much as a small workplace pension, a private pension pot, part-time earnings, or rental income on the side, that exemption does not apply to you. You will still be taxed in the normal way through adjustments to your tax code on that other income. Two pensioners could be receiving the exact same total amount of money every month, and only one of them ends up paying tax purely because of where that income comes from. It's an odd, uneven system, and it's one of the reasons HMRC has been fielding so many confused and frustrated messages from pensioners lately, including plenty of people publicly asking HMRC directly why their tax code suddenly changed. Beyond the personal allowance squeeze, there's a second reason your tax code might have shifted, and it has to do with how HMRC handles multiple pensions and lump sum withdrawals. If you've recently started drawing from a new pension pot, taken a lump sum, or begun a flexible drawdown, your pension provider might not have full visibility into your total income yet. When that happens, HMRC or your provider can apply what's called an emergency tax code, sometimes shown as something like 1257L with an M1 or W1 attached to it. That little addition matters enormously. It tells the system to calculate your tax as if this single payment were your entire income for the whole year, rather than spreading your allowance evenly across 12 months. The result is that a one-off lump sum can get taxed far more heavily than it should be, sometimes shockingly so. The good news is that HMRC has been working to reduce how often these emergency codes get triggered, and to speed up refunds when they do happen. But the system still isn't perfect, and plenty of pensioners are still being caught out, especially those juggling income from more than one pension provider at once. So, what should you actually do if you think your tax code might be wrong, or if your payment just dropped and you don't understand why? First, don't panic, and don't assume the worst. Start by pulling up your PAYE coding notice, which HMRC sends out, often referred to as a P2. You can also check your tax code directly through the HMRC app or your personal tax account online, and it's genuinely worth doing this every April when the new tax year begins, because that's prime time for mistakes to creep in. Compare the code shown there against the code your pension provider is actually using on your latest payslip. These two numbers should match exactly. If they don't, that mismatch alone can explain a sudden change in your take-home amount. Second, look closely at what's driving your code. Is it reflecting your state pension correctly? Is there an old employment benefit still sitting on there from years ago, like private medical insurance from a job you left long before you retired? These leftover adjustments get carried forward automatically sometimes, and they can silently eat into your allowance without you ever realizing why. Third, if you've got more than one pension, make sure you're looking at all of your tax codes together, not just one in isolation, because your total allowance needs to be spread correctly across every source of income you have. If something looks off, contact HMRC directly. Yes, the wait times can be frustrating, but this is genuinely one of those situations where a 5 or 10-minute phone call or a message through your online personal tax account can save you a significant amount of money, either by fixing an ongoing error going forward or by getting you a refund for tax you've already overpaid. And if you've overpaid, you do not have to wait until the end of the tax year to get that money back. You can often claim it back much sooner once the correction is made. For anyone who finds this whole system genuinely overwhelming, and plenty of people do because it is not designed to be intuitive, it may also be worth having a conversation with a financial advisor, particularly if you're managing withdrawals from a private pension pot and trying to figure out the most tax-efficient way to draw that money down over time. Here's the bigger picture to keep in mind going forward. This isn't a one-off glitch that's going to sort itself out. As long as the personal allowance stays frozen and the state pension keeps rising every year through the triple lock, this squeeze is only going to get tighter, not looser. More and more pensioners are going to find themselves crossing into taxable territory for the first time, and more people are going to see their tax codes shift as a result. The planned exemption for pensioners relying solely on the state pension is a welcome step for the people it covers, but it leaves a genuine gap for anyone with even a modest amount of additional income, and the government still hasn't spelled out exactly how that exemption will work in practice. Staying on top of your tax code isn't optional busy work anymore. It's become an essential part of managing your retirement income every single year. If this video helped make sense of what's happening with your pension and your tax code, do me a favor and hit that like button. Drop a comment below if you've noticed changes to your own payments recently, and make sure you subscribe to my channel so you don't miss the next video, because there's a lot more changing in this space over the coming months, and I'll be breaking it all down right here. Thanks for watching, and I'll see you in the next one.